Have you ever wondered, what is a stock? We hear about that all the time, but do you really know what stocks are? If those are questions that you have, I have some answers for you. Before I start on this video, I want to remind you that I have a free workshop that is available to you by clicking on the link in the description box below this video. It's about 90 minutes long. I'm not trying to sell you anything. I'm just trying to offer you some insight and different ways that I think, and to help you possibly think in different ways yourself. The coverage includes a lot of different areas. Of course, I talk about the financial markets in general and a little bit about the stock market itself. I also cover sports. I'm a big fan of sports. Music. I've been playing music since I was very young. And I also talk about professional and personal relationships. The goal of this workshop is to help you to think in either new or different ways, as well as for you to get to know me and my style. When we go to define stock, we may know that this is a very important thing, and we should know something about it. Do we really know things about stock? I'm just going to give you a brief overview in this video of what stocks are so that you have a basic understanding, and then you can use that to build and learn more about stocks. Stock represents ownership of a company. So if you have some stock in a company, you are a part owner of that company. Stock is created when a company decides to give away by selling part ownership of a company. You get some people together, they decide we're growing, we're successful, we really want to expand, we really want to become more well-known. Let's go ahead and make part of our company available for people to buy and sell. If you own stock, that'll also be referred to as equity. So we may talk about the stock market or the equity markets. They mean the same thing. A unit of ownership is called a share, and this share can fluctuate in value each day. If you have a stock that has a lot of volume and a lot of shares, it can go all over the place like an EKG every day. There are millions and millions of people participating in the stock price. They may get in right at the open, they may get out right at the close, but while the stock market is open, these shares are constantly fluctuating in price. So why do companies even consider giving part ownership away? This is done to raise capital, so they want to raise some money, and to serve as an incentive for a company to increase profits. If you're part owner of a company, now the people in that company and the board of directors of that company, they are accountable to you. And if you don't like them as part owner, you have some ways that you can make your opinions known. Most companies, however, in the U.S. are privately held. They may have stock. It's just not available on a public exchange. You can't go to your brokerage account and buy and sell it. There are thousands of companies that have stock that is publicly traded, and a lot of these are household names. General Electric, Disney, Microsoft, Apple, Google. These are names that you probably know a lot about and do business with and enjoy their products. You can also buy and sell shares of their stock. The reason for owning stock in the first place is that it's hoped that over time, and this could be a short period of time, maybe a few months, or a longer period of time, maybe years or even decades, the value of those shares that you own, whether they're public or private, will increase in value. You may hear about a term called going public. This is when a company no longer wants to be just a privately held company. Now they want to go public and make shares of their company available to the public. Many companies decide to go public. They are also called a publicly traded company. The stock that trades, shares meaning they can be bought or sold, are done so on a stock exchange that is open to the public. This can include the New York Stock Exchange, the Nasdaq, or a number of different stock exchanges that are available not only in the US, but throughout the world. Now, don't think you can just walk in to a stock exchange and plop down some money and think you're going to be given some stock. or that you can walk in and sell some stock. It doesn't work like that. You have to go through a brokerage account. The people that work at the exchange, there's a lot of different support staff, but people usually have what's called a seat on that exchange. And they're the ones that actually do the buying and selling. Investors and traders with a legal brokerage account, and yes, there are some illegal brokerage accounts, just watch the movie Boiler Room, they can publicly buy or sell shares of a company. So you can open up an account at Charles Schwab, at TD Ameritrade, all the different brokerage outfits that are available. Once you fund that account, you then have the ability to buy shares of stock. You can then sell those shares at any time you desire. As the company expands or contracts, they get bigger or smaller, the stock's price per share is determined by the market. Stock prices are determined by the forces of supply and demand. Prices can be influenced by a lot of different things. This can include the real value of a company. What are they really worth? We have what the stock market says that company is worth, but maybe you do some analysis and you come up with a different number. It may be greater than the current stock price. It might be lower than the current stock price. Or, over a period of time, companies do lose money and they have a lack of value. They see a decrease in earnings, a decrease in new products, a decrease in the management, and you'll usually see the stock price go down. There's also the perceived value. This is what the market thinks it's worth. And the two sometimes get out of line with each other. There's a discipline for analysis called fundamental analysis, where investors try to pick out those stocks they think are cheap. They crunch all of their numbers and they come up with a value, let's say at $30 per share, but they notice that the stock is currently trading at $20 per share. To them, that is considered inexpensive, and so they buy that stock. After a period of time, they crunch their numbers some more, and let's say the stock has gone to $50 per share. They realize through their own analysis that the stock is really only worth $45 per share. It's considered expensive at that point, and so they sell those shares. That's the main method of market timing that somebody that uses fundamental analysis will implement. Companies have different types of stock, but for most individual investors, the type of stock that is dealt with most is called common stock, and it's usually held onto by your broker. It has a street name. It doesn't necessarily have your name attached to that stock. You can get stock like that. But if you're in a high liquid environment where you're buying stock and then in the not too distant future maybe selling that stock, it's probably held onto by your broker. And most of the prices that you hear about in the financial news and on the internet usually has to do with common stock. But that's not the only kind of stock there is. When a company first goes public, that is called an initial public offering or an IPO. Some people are real excited about this. They want to get in before it goes public, thinking that it will really jump in value, or the day that it goes public, they'll really jump in. There are different services and websites that can help you with this if this is something that is of interest to you. Other investors prefer to have more time-tested stocks. Just because it starts off really well doesn't mean in 3 months or 6 months or in a few years, there's a possibility that that stock may not even exist anymore. Just think back to the dot-com bust in the early 2000s. Let's talk about the different types of stocks. A company can have different kinds of stock. The two main types that we talk about and that most investors get involved in are common stock, which I just talked about. And when you have common stock, that does mean that you have voting rights. When I said you can make your opinions known earlier, this is a large way you can do that. You are registered as an owner of that company, and usually in the mail or by email or going to their website, you'll have the ability to vote. A lot of times you might vote by proxy. You don't know these people. You don't know their names. You're just looking at the stock price. That's all you care about. You don't really want to get involved in the day-to-day mundane tasks that a company may endure. Or you may really get into that. There are a lot of shareholders that go to the annual shareholders meetings and they make their opinions known. Others are more passive and they just lay back and just want to look at the value of the stock itself. You can get as involved in this as you would like or stay as passive as you like. Some common stocks will pay dividends. The idea behind common stock is growth. We want to see a stock that we buy at 10 go to 15 or 20. There are other investors who do like the dividends. They want to buy a stock at 10, and as long as it stays right around 10, if they're getting a 2, 3, 4, 5% annual dividend on that stock, then they're happy with that. Another kind of stock that does focus more on dividends is called preferred stock. Generally, you won't have voting rights when you own preferred stock. So if that's a real big thing to you, you may want to look at buying common stock. If generating dividends is what's important to you, preferred stock may be more of what you want to do. Usually, preferred stocks will pay a higher dividend than common stock, and one benefit of preferred stock is that the dividends that are paid to preferred stockholders is paid first before any dividends are paid to common stock holders. Let's look at some of the different classes of stocks. Some have different names for their types of stock. Often a company may have different classes. Some of these classes will have different voting rights. Some allow you to vote for the board of directors. Some types of stock ownership do not have voting rights. You might hear them referred to as Class A, and usually the company quite often will come up with what Class A means, although there is some general meaning behind them. Then Class B shares. Classes are developed and used in order to maintain control. If you started a company, it's nice to be popular and to be successful, but as your company grows and the value of the stock increases, you still want to maintain control of your company. There have been companies that have been taken over by other companies or hedge funds or different predatory type methods. Think of Michael Milken back in the 80s, where a company puts too much stock out there and before they know it, they lose control of that company and they're forced out. Different classes can make a company more difficult to be taken over. And when a company does that, if they come in and buy shares of a company or a hedge fund or some kind of a entity comes in and starts buying a lot of stock to try to take it over, where the company doesn't want that to happen, that is called a hostile takeover. There are also a type of shares in stock called advisor shares. This might be the kind of stock that you get when you help out a company that's just getting off the ground. People take a risk when they're starting up a company. You might put your life savings into a company to get that off the ground. You might have other people that you need to come in and help you, and you really can't afford to pay them. So you give them stock in return. A lot of people will give you insight and expertise, but you have people that are founders of a company, and they're taking a lot of risk. They have good insight and they have expertise. The idea is to reward them with a different kind of stock as compensation. This could be the company's founders or high-level executives. You don't really start out as high-level at a brand new company, but you may develop into a high-level executive. One time I met the very first employee ever hired by Microsoft. And believe me, she didn't drive around in a 1973 Pinto either. She wasn't paid very much money at the time because they really couldn't afford to pay her very much, but she was given very lucrative stock options, which she exercised and has never had to work since, unless she wants to. When I met her, she has a foundation and she was looking at doing some programs for people that don't have access to technology. Advisor shares can also be compensation for people who helped get the company started or to get it going. And that's pretty much what I already referred to. Different classes may exist for load and no load mutual funds. If you don't know what that means, don't worry. Load just means, are you paying a fee up front? No load means you don't pay a fee up front. You pay fees other ways with mutual funds. Believe me, you pay. It's just pay me now or pay me later. There are also different kinds of stock. If you're an investor that really wants to buy a stock at 10 and eventually sell it at 20 or 30 or 800 or whatever you want to do, that is called a growth stock. You don't really care about the dividends. You want a stock that's going to increase in value. That is your main concern. And there's a period of time when growth stocks do very well in the market. There are other investors who might be getting near or they're at retirement age, and they've spent their life in growth stocks, and they've been doing all the research, and they've found the good and the bad, and they've been through the ups and down times. They want to take it easy now. They want to live off of their investments. One thing they can do is get into bonds, which I have a video that explains the basics of bonds. Another thing that investors will often do is switch over to more high dividend stocks, maybe preferred stocks that are giving them an attractive yield. They put that into the stock, and then every quarter or twice a year or every year, they are paid that dividend that goes into their bank account, and that's what they use as part of their income. There's also a thing called defensive stocks. The market goes up and the market goes down. During down times, people will shift from growth stocks over into more defensive stocks. And I go into this in more depth in the classes that I teach. Sometimes we might refer to these as value stocks. They tend to weather the storm better. Things like consumer staples. No matter what the economy's doing, people still need milk, they still need soap, they still need toilet paper and toothpaste. So the companies that produce those things will generally not get hit as bad if we're having a real downturn in the market as companies that are considered growth stocks. If you are part owner of a company, what does that mean? The more shares that you own, the greater the percentage an investor or the investors own of the outstanding shares. Let's say there are 1 million shares and somebody owns greater than 50% of those shares. They are a majority shareholder, and that might be one of the ways that a company can come in and take over another company. One thing to keep in mind, though, is the property that a company owns, it does not belong to the shareholders. Let's say you own Disney and you get mad at Disney for some reason, and so you go down and you figure, I'm going to steal Mickey Mouse, or I'm going to walk into this company that I own shares in and take one of their chairs or take one of their computers. That's theft. Even though you're part owner, you're not that much of an owner. But on the other hand, if a company really gets into trouble and they get a lot of debt, such as liabilities, if they go broke and they end up owing a lot of money, isn't it nice that they can't come after you or your house or your job? So there's limited ownership in the control that you have that way, but there's also limited liability as well. So shareholders have no rights to company property. You can't go in there and say, this chunk of land belongs to me. I'm going to camp here for the weekend. You probably will have your day in court. Ownership gives the right to vote. If you are ownership, the company has declared a dividend, you have a right to receive those dividends if there are any. And you can go out and sell that stock at any time with a publicly traded company. You might own Google right now. You don't like owning them anymore. All you have to do is log into your brokerage account, set things up, hit a couple of buttons, and you've sold that stock. Let's talk a little bit about, is going public a good thing? This has been a real benefit for some companies. This has been a real drawback for some companies as well as investors who got taken in by this great opportunity only to have it fizzle out. They end up losing either a large chunk of their money, if not all of their money in their investment. There are advantages and disadvantages to going public, becoming an IPO. Some of the advantages of being an IPO are to raise capital. That's what I talked about at the very beginning. If a company sits down and says, we want to expand, we want to hire more people, we want to go into other states, we want to go international, well, you need money to do that. How are you going to raise that money? One way is to sell off part of the company or to pay down debt. A lot of companies have massive amounts of debt before they really mature. So they may sell some of their stock, use the money that they get for that, and then pay down or pay off any debt that they have. To do research and development. There might be new products, new technologies, new places, new things that they want to explore This takes money. You have to hire the people, you have to do the research, you have to have the facilities. All of that costs money. And for publicity, there are a lot of people who really follow the IPO market. And a lot of these companies are well known before they even go public. There is a level of publicity. There are usually press releases, there might be promotional videos, there might be different outfits that promote a stock. And so people that have never heard of a company before, now they're starting to hear about that. Some of the disadvantages of going public is now a company that was used to doing things a certain way, they have to disclose information that maybe they didn't have to disclose before. Public companies are regulated. You can't hide things in public companies that may be hidden in some private companies. And to hire the accountants, to hire the people, to have the computers, to set all of this up, it can be costly. And you have to hire an investment firm or investment bank to help you with the whole process, and they're certainly going to want their chunk of the change as well. Once you give away part ownership, now there's an added pressure to increase profits. You may have been held accountable as the owner of a company, or maybe you founded a company. You might have to answer to yourself or to your spouse if that's your board of directors, or if you have a group of people that help you, you answer to them. Well, when you go public, now you have shareholders that you have to answer to as well. So let's switch gears a little bit and talk about a thing called lot. A lot, not a lot, lot. When stocks trade, they typically will trade in what's called a lot. One lot is 100 shares. And there are a lot of reasons for doing it this way. You might see the ticker going across that says $23.50. That's for one share. If you're going to go in and buy a lot of shares, you're going to have to multiply that by 100 to come up with the price that you're going to pay. For example, a company's shares may be worth $50 per share. In real dollars, that means that you're going to go in and buy $5,000 worth of stock. I'm not talking about buying on margin or anything like that. This is just the worth of that stock at the time you buy it. If you have anything that's other than 100, 200, 300, 400, that is called an odd lot. If a transaction is less than 100 shares, and some people do this, they don't say, give me 100 shares of Microsoft. They say, give me $1,000 worth of Microsoft. And that might work out to some really weird number of shares that you actually own. Any trade that is not based on 100 is also a form of an odd lot. Let's say you go in and buy 192 shares. Well, the 100, that is a round lot. But the 92 shares, that is an odd lot. The program that I teach is called the Spx Investing Program. And in that program, as well as many other investors or traders, and again, the definition of an investor is if you hold something longer than 1 year. That's mainly for tax purposes, although this is changing all the time. If you hold something for less than 1 year, you are considered a trader. The only kind of things that I teach in the program are based on round lots, because we do a lot of option strategies. And one option contract is based on 100 shares. We can't do 53 shares or 162 shares. We have to do 100, 200, 300. And a lot of investors base their strategies on that as well. If you want to hedge your investments, you need to do it in round lots. If you have an odd number of shares in your portfolio, it might be more complicated to protect those if that's what you want to do. What are some of the stock exchanges? Where is the stock mall, if you will? Where can we go and actually buy and sell these things? Fortunately, we don't have to physically go to these places. We can do this electronically. But publicly traded stocks are traded on what's called a stock exchange. It's just a stock store. After the IPO, a stock then trades in what's called the secondary market. Initially, the IPO, that's the primary market. Once it's then made available to individual investors or institutions or any investor, now that is called the secondary market. There are many stock exchanges in the US and around the world. The most famous stock exchange, and one you've probably heard of and maybe have even seen pictures of, is the New York Stock Exchange. Oftentimes, we'll just refer to this by its acronym, NYSE. Other stock exchanges that you might have heard about include the American Stock Exchange, which is also in New York, doesn't do as much, but a lot of the exchange-traded funds go through the American Stock Exchange. The Nasdaq, that's usually for more tech companies or smaller companies, a little more risky companies. But at the same time, you have other companies such as Apple, Microsoft, Cisco, Starbucks. Those are all companies that trade on the Nasdaq. So let's look a little bit at the NYSE. It's located on Wall Street. That's where we get the term Wall Street from, the fat cats on Wall Street, in New York. It's also known as the Big Board. They used to have a huge chalkboard where they would write down the prices. And they still have a really big board there today, but it's all electronic, where you can see everything at a glance. Not only what's happening at the New York Stock Exchange, but what's happening on the Nasdaq, or what's happening in Chicago with bonds or with options, or in the futures markets. There's a tight connection. It's the world's largest stock exchange. As of early 2021, it has a combined market capitalization of $24.5 trillion. And just think, the US has debt now of about $30 trillion. So even if you took all of the companies in America that publicly trade and sold them, you still wouldn't be able to pay off the debt of the US government. And this changes all the time. The entire stock market, including the Nasdaq and the other exchanges, at the end of 2020 was valued at over $50 trillion. And again, that changes every day as markets go up and down. So just to give you an idea, you see the NYSE is $24.5 trillion. It's about half of the total value of US stocks. And I couldn't find any figure earlier than 2013. And this number is likely to be a lot different now. But finding current information about this is really difficult. In 2013, the trading value, what actually went back and forth, was about $169 billion. It's way more than that now. Trading volume, as of about May 2018, was about 3.6 billion shares per day. In the current climate, if we have under 1 billion shares traded for any particular day, that's considered a slow day. Average is right around 3. We can get up to 5 or 6 billion shares any day. And the technology is able to handle a lot more than that, or so we're told. That was one of the problems in the 1987 crash, was that people wanted to trade, but it was overwhelming the systems, and they weren't able to sell. And that just led to more panic and more craziness. And you had brokers unplugging their phones because there's nothing they could do about it. The NYSE was founded originally in 1817. Prior to 1817, stock transactions were done according to a Buttonwood Agreement that was made in 1792. So it's been around a long time. Across from Wall Street is a buttonwood tree. And some people used to gather there and they would haggle and, I'll sell you this stock, I'll buy this stock. Well, they moved across the street into a building, and that is where we get the NYSE from. There's about 2,800 companies listed, and this can change too. Companies fall off, new companies come on, so this is a pretty fluid number. One way that you can tell it's a New York Stock Exchange stock is it'll have 1, 2, or 3 letters for the stock symbol. Usually if it's 4 or more, that's a Nasdaq stock. Some famous companies that are traded on the NYSE include General Electric, GE, which was a member of the Dow. That used to be one of my favorite trivia questions. What is the one remaining stock that is original member of the Dow? Well, a few years back, they decided to take that out of the Dow, so I can't use that as useless trivia anymore. But GE, big stretch on that one, that's the symbol. And symbols do change. There was a period of time when the symbol C meant Chrysler. Then it meant Citibank or Citigroup. Then another company, and I'm kind of particular about this being from the Seattle area, is Boeing, and the symbol is BA. Let's talk a little bit about the Nasdaq. And some people want to know, what does Nasdaq mean? Well, it's the National Association of Securities Dealers Automated Quotations. Yeah, who came up with that? We just call it the Nasdaq. It's the second largest stock exchange in the world. The average daily volume is a bit over 5 billion shares. Again, we can see a lot more than that on really crazy days and less than that on slow days. There's about 3,300 stocks that trade on the Nasdaq. So you take them all together, you've got a universe of 5,000 to 6,000 stocks to choose from. No wonder people are always looking for inside tips when it comes to stocks. The Nasdaq opened in 1971 to allow for advances in technology. Now, in 1971, that meant phone lines, because it used to use the open outcry method only at the New York Stock Exchange. Now it's all switched to computers, where people would be screaming back and forth with all these crazy hand signals, and then at the end of the day, you'd see all these bits of paper laying on the floor. The Nasdaq was brought in to do things in a new way. I think their computers are actually housed in Connecticut. I could be wrong about that. They're probably backed up all over the world. But the idea was that the Nasdaq would use more technology. Most stocks in the Nasdaq have at least 4 letters. They can have more than that. Examples are MSFT, Microsoft; Apple, AAPL, APPL was already taken; and Starbucks, SBucks; and Google, GOOG. And there's 2 different kinds of Google, and they're both included in the S&P 500. They're different classes. So which exchange? We've got the Nasdaq, we've got the NYSE. Which one do we use? Well, for most of us, it doesn't matter. There are even stock exchanges located throughout the US and around the world. You may put in your order to buy or sell thinking that the transaction is taking place in New York when it might be taking place in a different location. So it's not important for most investors and traders to know which exchange a particular stock is traded. And some of these are global. There's the extended session, there's the overnight session. So a lot of these stocks trade pretty much 24/6. They stop Friday afternoon and pick up Sunday afternoon or evening. Technology allows for proper routing and tracking. Now, if you want to go through a particular exchange, the software that I use allows you to do that. What I'm looking for, though, is I want the best price as fast as possible. So I don't really care where the trade actually gets executed. Then there's a thing called arbitrage. So if you have all these stocks, let's say Microsoft, and it's trading at one price in New York, but it's trading at a higher or a lower price in London, ooh, don't you see a chance for some real easy money? The current price of Microsoft escapes me as I record this, but let's just say it's $100 a share. I know it's way different than that. Let's say it's trading at $100 per share in New York. The price in London is $101 per share. You could go in and do an arbitrage move where you buy it in New York for $100 and then immediately sell it in London at $101. You've just made a $1 profit that took a few seconds. Now, before you get all hot and bothered thinking you can do this, don't. There are lots of people that are arbitrageurs, and there are computers that are constantly looking for these discrepancies out there. And they can do this thing so fast, and they do it in all kinds of decimal places. We only see 2 decimal places, but there are all different kinds of decimal places that we don't see. And the computers pick up on that, and they may do these very large shares really quickly, because if you're buying in one place, that's pushing the price up. If you're selling in another place, that's pushing the price down. And eventually, over a short period of time, the two will come back in line with each other. But believe me, there are people who've tried to make money this way. And at one time, you probably could have. But with technology the way it is, that's not a real good strategy to use right now. For most investors and traders, all major exchanges are involved. Again, we just want our trade executed as fast as possible and at the best possible price. You might even get it from your broker. They go in and they buy a chunk. They may give you what's close to the current quoted price, but your trade may not have actually gone to an exchange. It may just go through your brokerage firm. So I want to thank you for taking the time to watch this video. I appreciate that. If desired, please click a like or a dislike with the button below. That'll really help things grow with the channel as we're getting going with things here. Please leave any comments, either positive or negative. The First Amendment is still practiced on this YouTube channel. Also, consider subscribing to this channel. That'll really help things out a lot too by clicking on the little dingy bell down below, and you'll be notified when any new videos are posted. And as I said at the beginning of this video, there is the free workshop that's available to you, and some of you might find that helpful and useful. So with that being said, thank you again, and I'll talk to you in the next video.